Mhm. We can see.
All right. Perfect. We'll wait a minute and let people join.
So I think we have a few more people coming in slowly, but just in the interest of time, I think we could start with the introductions and we'll go from there. So thank you everybody for joining us today. This basic, we'll get an hour CPE if you attend and participate in the polling questions. So presenters today. So I'm Alex. I'm the partner in charge of the tax group here at Akram. For those of you that don't know, our firm primarily provides audit and tax support for the alternative investment fund space. Most of our client work is audits and tax returns for alternative investment vehicles. We also handle management companies, individual taxation, accounting, support for funds outside of just the audits, and we have a family office practice as well. Joining me is Greg Popes from Fundviews Capital. Greg, if you'd like to tell a little bit about yourself and the firm.
Sure. My name is Greg. I started Fundviews Capital. I'm the co-founder of Fundviews Capital. We started in 2021. We service and manage operations for emerging managers and asset-driven or advisor-driven funds. Excuse me. So financial advisors are looking to launch private investment funds, whether it's a fund of funds, feeder vehicle, or otherwise. We help coordinate and manage all of the tax and audit deliverables with Alex and his team, as well as the fund administration, some levels of compliance, legal, and other aspects of running the vehicle. So we deal with a lot of different things operationally, but on behalf of now over 40 different funds and over 600 million in assets under service.
So this was actually Greg's idea to have this webinar. We do some things throughout the year. One of the things that as a tax return preparer, I've been doing this 27 years, we send a draft return out. Sometimes the clients have questions. This webinar also, I think, applies to people that are working in this space. So it's really sort of targeted at folks like Greg, people that are a service provider in between the tax return preparer and the fund, or personnel at the funds themselves. But we also get into some level of detail that, if you're working in the space as an accountant and preparing these K1s and you want to review, I can go over some of those things. So without further ado, let's just jump right in. So I have a lot of content here in the slides, which we won't be able to go into in quite the depth. Probably need about another 30 minutes to drill all the way down. So we're going to go over some of the points that I think are more important or relevant. I encourage everybody to look a little deeper into some of the content in the slides. However, after the session, you may find some things there. And then I also have a redacted K1 that we're going to kind of flip back and forth to as an example as we go over some of these concepts. We'll flip back into the K1 and we'll kind of look at these things. So here's a little bit about the firms we already mentioned. So just the introduction here. Why do we need Schedule K1s? Who gets them? And then what are some of the key filing dates? I'm actually going to touch on amending returns as well. I'm going to do that on the front end. I think this is a pretty important point, so I'll get to that at the end as well. So essentially, anytime you have a partnership, it's generally viewed as a flow-through or a transparent entity. That means that, if we think about, and this is the context primarily of investment funds, although it does apply to any other partnership, operating companies as well. I think the audience here are probably interested in management company and fund K1s. This applies to any partnership that's filing a return. So the entity itself is going to figure out all of its tax items, the entity level, and then to the extent that there are at least two partners, based on the partnership agreement and the economics of that arrangement between the partners, whatever those total items are that are determined at the entity level are going to be allocated to a partner on their K1, so that's their share. So just a very simple example, Greg and I started a business and we were 50-50, and the business made $10,000 in year one. That Form 1065 is going to break out all the items that lead into that $10,000. He'll get a K1 with 5,000 total, and I'll have a K1 with 5,000 total. So whoever gets a K1 or people that have a profits or capital interest in partnership. So, if you have you prepared a subscription agreement, or there's an investment management agreement between you and that partnership, that will give you the right to earn that income or with capital there. Key filing dates. So partnership tax returns initial due date is March 15th for a calendar year partnership ending 12/31. There's a extension available to September 15th. Practically speaking, for most of the funds we do, unless we're going to get that return done sometime in February, we're probably going to extend them all. That just eliminates the possibility of late filing. General practice to prepare the K1s to get them out as soon as you can, depending on the underlying information that can drag out for some time. The individual tax return preparer has a filing due date of 4/15, which can be extended until 10/15. So with these deadlines in general, if everything's going as it should, you should have no less than a month of time, even if you got the K1 on the last filing day, to be able to incorporate it into your individual tax return. So what's
just
on the
that note, Alex, before you keep going, two quick things that stand out that may not be apparent for everyone, depending on your experience level. One is when we're talking about partnerships, it's also LLCs that are taxed as a partnership. So it doesn't have to be an actual partnership. It can also be, it doesn't have to be an LP, I should say. LPGP entity, it could be an LLC as well. And that's very common in funds. The other thing I'd say is that it's very common that these do get extended, and you do file very late in that side. And the only real time when it kind of butts heads is if you're let's say setting up a family entity, an investment company, and you're investing in a fund, and that fund doesn't give their K1s to you until the last filing day. Well, you also, for that entity, if it's a partnership, have to, or an entity, have that same deadline. So that's the only time when it really gets tricky, because you may not be able to file until the last couple days. But someone has to turn that around very fast. So you got to be aware, if you have a lot of entities that are invested in your fund, you have to be aware of that deadline.
Greg, a good point on the LLC. Also should mention that it's not uncommon for certain foreign vehicles to be formed or limited as part of the fund structure, especially if you have offshore investors or tax exempts, and then sometimes that limited can file a partnership return as well by making an election to be treated as a partnership. So it's not always LPs, to your point. And then I also did want to touch on the amending. So one of the reasons that I think this K1 review process is so important is, for other tax return filers, an individual return or a corporate return, even an S corp return, if let's say you file the return, and then we find later, we send the K1s out, people have questions, and we realize that there's something that was not correct in that return or those K1s. For a 1040 filer in that situation, if they file the return in June and then they realize in December that something was missed or they had an error, they can amend that return at any time to correct it. For partnerships, they came out with something probably about 10 years ago now, maybe not quite that long, the centralized audit regime. And what they, one of the challenges is, imagine a partnership that has 50 partners, and then there's an error, and then 50 K1s need to be amended. Then there's 50 separate returns that the IRS then has to sort of chase, see that they get amended and match everything out. So they came up with a set of rules, kind of goes beyond the scope of today's session, that essentially makes those changes. You can't kind of go back. Like if you miss that filing date, we get to September 15th and it's October, and 1040 filers are looking at their K1s and they think there's an error, and then there's a conversation with the tax return preparer and they say, you know what, you're right, there's something wrong here. We can't just amend that K1 and return we just did. It's going through a process called an administrative adjustment request, and effectively the takeaway point here is any changes to that K1 are going to be reflected on, for the taxpayer, the partner, for the year in which that amendment was filed. So using 2024 returns as an example, if a client came to us and said, hey, we had some bad piece of data that went into this return, we need to amend it. If we do that as quickly as we can and get it done within a week, it's going to go out on a form. That means that change will be, because it's in 2025, that change will be on that partner's 2025 tax return. So that 24 return stays as filed, and then that correction happens in 25, which, can be a problem. If we give somebody too much capital gain, for example, and then you give them a capital loss that next year, you can't carry that back. So there's a tax inefficiency. So it's really important with partnership returns in particular that everybody's like really comfortable that they're correct before you get to that extended filing deadline. If you file in June and you find that there's an error in July, there's the time to fix it. You have to do it before that filing deadline. So just wanted to point that out. Without further ado, let's just get right into the meat here. So I do have a redacted K1. I'm going to flip screens back and forth, but the main part of the return is part 1, part 2, and part 3, which I'll just see if I can't do this here. So this has been redacted. So, Greg, can you see this?
Yep.
Just come through. Okay.
Perfect.
So part one is information about the partnership. We've pulled a lot of this detail out, of course. But for review, you want to make sure that partner's tax ID number matches, fund name, some of these things all make sense. Down here, sections E, F, and G through J relate to that partner's ownership or identity, tax ID numbers, entity type. These, in a fund context, these are things that should be filled out on their subscription agreement, forms W-9 or W-8 pending foreign or US. And, it can be updated, right? Somebody moves, there's a transfer to a trust, all those things. So one of the things that we try to do on the front end is get that partner demographic data sorted before we're shooting K1s out, right? That's something you can do early, like January 2nd, exactly who's in the partnership and should have updated info. Part 2, so continuing part 2. Now this is where a lot of people spend their time, right? This partner's capital account analysis. And one thing I've noticed is I think in 2018, 2019, somewhere in there, 2020, forget exactly when, the IRS, they used to have boxes down here where you could indicate the nature of the capital account, whether it was GAAP, 704B, tax basis, or other. They switched it to, it's mandatory to file K1s with tax basis. So for an alternative investment investor, the value here is not their capital account value in almost all cases. Things that are typically different between book account, which is your capital account value. So, a partner gets their December statement, and let's take this partner, for example. Their December statement may say that the account value is 130,000, right? So we send the K1 to them. First thing they look at is 114,206, and they're like, this isn't right. I have 15,000 more value in here. What do I, how do I, reconcile that? So we'll get into, how we can make sure that that's correct. That's definitely an area of focus, is the capital account section. And then part 3, this is our distributor share. So this is really the tax items, right? So, a lot of folks on this call are maybe have seen K1s or somewhat familiar with K1s, but many more people are familiar with 1099s, right? We have a account, we get interest and dividends and capital gains. So just like the 1099 gives us all the numbers and boxes we can put into our 1040 return, same thing with the K1. This is all the items of income, and there's other informational items here as well. So let's get back to the presentation. So we give some things to keep an eye out for, why these might be more important. We'll kind of skim over that given the time constraints, but it's important. So the one thing I would say is people are trying to understand the nature, like, why do I have box 1 income? What is that? Really, it's not the K1 review that's going to answer that question. It's going back to that 1065, because that's the total, right? So that process there. Maybe we can do a session on how to review a 1060B. There should be a reconciliation process 5. We can get into. Let's see. So what should we have available? What should I have handy? Generally, prior year K1s. The capital roll forward, generally that's your partner accounting, right? So if we have a fund that's using an admin service, that's going to be the January through December 2024 current year accounting. Partnership agreement, if we wanted to dig into, understanding the allocations to make sure that's correct. And then investor admin statements, which this is what the investor is looking at. If we want to try to understand the character of those items, it's that 1065 reconciliation process. It's all the supporting information that was provided for that return. 1099s, PFIC statements, K1s, anything else that's accounting, anything that's going into that return, that would be helpful. And then, to the extent that you have complex allocations, waterfall for private equity, there's management fee calcs that are different between investors, carried interest, there's contribution or distribution of property. All these things are going to be critical to understand to make sure that they're reflected properly in the K1.
Alex, can you spend 2 seconds here and just explain why or what a K2, K3 is? Because that's kind of a newer change, right? Maybe
Yeah.
when that comes into play.
Yeah, sure. So K2, K3, it used to be that on the K1, K2, K3, it used to be on the K1, there was a section over here that was foreign income and foreign taxes. And if you'll notice down here, I don't know how large this is showing up on the screen, but line 21 is foreign taxes paid or accrued. The K2, and it's really K3. K2 is the form that's on the 1065. So if we have them and we're reviewing K1s, it's the K3. The K3 is kind of the equivalent of the K1 to the 1065. So the K2 is the total for the fund, the K3 is attached to the K1. So all the detail that you're going to need as an individual investor to determine what your foreign tax credit information is will be contained in the K3. There's also other information in there that is important to, so here's the first page of the K3, and this goes, for many pages. We'll go through that, a little bit later. But that's if you're a fund that has, investments in foreign assets like PFICs or passive foreign investment companies or foreign entities, or you have foreign interest dividends, royalties, things like that, you'll likely have a K3.
Yeah, makes sense. So it's basically if you have taxes that the underlying investments or funds or whatever you're investing in is paid internationally, you get a credit kind of on your K1. Is that how that works?
Yeah, so the most common place you see it is if, let's say it's a long short equity trader and they're trading non-US equities, or British Petroleum Oil or a Canadian mining company or things like that. And that stock that you held pays a dividend, there's likely going to be a foreign tax withheld from source, like that's going to mandate that K3.
Got it. Perfect.
So first step, what do we do? We're just looking at, we already kind of looked at the face of the K1, make sure it makes sense. It's the partnership name right, it's the tax ID number the same. Certain things you can't take for granted. Sometimes there's changes in software, changes in preparer, and then things that you think would never change. Tax ID number's got a number flipped, so it's good. I would say it's good to just take one K1 and make sure all this are consistent with the prior year. That's where the prior year K1 comes in handy. Kind of put them side by side and just compare. The ownership percentage should make sense based on the economics. Any partner that is final that year, it's important to make sure that makes sense. Make sure that there aren't K1s marked final that shouldn't be marked final. If it's marked final, that means they shouldn't get a K1 that following year. And then there's certain things you expect to see in the capital account section and certain other things as well. Unusual accounting periods and short period items. The K1 at the top, it says, 2024 tax, 2024 K1 or tax year ending, and there's like blanks, right? So you can have a fiscal year partnership, short year partnership, or let's say, like we had a fund that closed down, and then let's say their last day of operations is June 30th, 2025. So we have 2.5 months to file that return. We can extend another 6. Let's say we got everything needed and we finished that return in August. It's going to be prepared on a K1 that says 2024, but at the top it'll say January 1, 2025 to June 30, 2025. So when you're getting these K1s, just check to make sure that it's actually for the calendar year, and then if it is a short year or fiscal year, do those dates make sense? Even though it says 24, that will be picked up on somebody's 25 return because it's January 1 through June 30, 25. And then, we should, again, this is where it's helpful to look at, have an understanding what the fund's doing and have prior K1, look at the footnotes, box 20 codes. There's lots of informational items on there that, may not mean much to the partnership reviewer, but could be meaningful to that end user, that K1. And then, is the K1 there? Does it reconcile back to the K1? And then if there's state source, has that been disseminated either through footnotes, state K1s, and some of those things? And then, states is another area that, people look at the federal K1, they say this looks good. There's a few state K1s, they skim through them quickly, not really sure what they're looking at. And then, it's not uncommon to have questions or things come up on state K1 review as well.
Yeah, and states, the state K1s, there's a whole separate section that we could go on forever, probably on state K1s, where, if it's a very immaterial amount of state source income in a certain state that's, not likely to care, then you can skip those certain filings. But it's always a judgment call, and it's always worth, having a discussion with your tax preparer about that. And about what states, you need to prepare at what times, and make sure that you're filing these and paying this stuff, on time. Especially for California and New York and some of the bigger states, they have more resources, and they tend to get upset when you don't file them or pay them on time.
And on that point too, Greg, another thing, many states have a mandatory non-resident partner withholding regime. So partnerships are pass-through entities. Generally, that means we're just taking that income and we're splitting it up. But anytime there's a recipient of income in a jurisdiction that jurisdiction doesn't have domain over, so non-resident partner would be one. The fund is based in New York, and they make an investment in a restaurant chain. It's a private equity fund, let's say, restaurant chain in Virginia. There's Virginia K1, Virginia income. Virginia tells that partnership in New York, we need you to withhold on the share, and the partnership owes us. Now that partner will get a credit for it, but that can be a surprise, not only to the partners, but to the fund management. So I think we're ready for our first polling question. So Zainab, who's helping out here, I think is going to.
So which part of the K1 usually contains partner identity and ownership percentage?
I think we're done that polling question.
Perfect.
Yeah.
Okay, so now we talked about, who gets K1s, kind of what's on there, high level review. Now getting into, now we want to talk capital accounts. And I think this is probably the area that, most people want to understand and be able to explain to their partners, LPs, how it all works. So as mentioned before, the capital account section is tax basis. So think of tax basis like, if you make investments, let's say you have a brokerage account and you're buying mutual fund shares, your original tax basis is sort of the accumulation of whatever capital you put into it. So let's say we make, $500 buys, on a monthly basis, and we do that for 12 months. We've got $6,000 invested in a mutual fund. That 6,000 represents basis in our mutual fund share. In addition to that, we get a K1 we get a 1099 from that mutual fund. Any dividends, interest, and things like that we've earned that have been reinvested, which result in additional share purchases, represents basis as well, right? So let's say that we have $100 of income there. Now we have basis of 6,100. When we get our statement from the mutual fund at the end of the year, it might tell us it's worth $7,000. So that example is a good proxy for kind of what happens on these K1s. If that investor said, hey, I'm going to cash out, I need this money, or I'd like to invest it in a different place, they can expect to have $900 of capital gains because they received $7,000, that was the proceeds, and then their adjusted basis was $6,100. So on the K1, this tax basis capital account should represent our basis in the position, such that if we were to compare that number to what our capital account statement is, that difference either it's a positive difference, which means we have an unrealized gain, or it's a negative difference, which we have an unrealized loss. That difference represents future taxable income or taxable loss, all the things being equal if you were to sell for that value on that day. So Greg, maybe you can, I know you guys do this a lot, have this conversation a lot with your clients. Any pointers or ways to think about how to explain that or give people comfort that
Yeah,
it makes sense?
we've gone through this a lot, especially lately. It's common where, depending on your strategy and wash sales and other things that are kind of complex, you can have very tax efficient strategies, such as, you invest in a private equity business that buys and rents heavy machinery. For instance, with the accelerated depreciation, you're going to have a massive amount of depreciation. What we saw with the tax basis versus capital versus GAAP differences or book value differences on that one was investors wondering why the investment is not doing well, when in fact it was. The investment's doing very well. It's just very tax advantaged in the short term until you sell that company down the road, and then you have to recapture some of that. But they saw this big loss and thought the company was losing money, when in fact it wasn't. It's quite profitable. On the flip side, you can have these very quirky situations that lead to higher tax income than what the investors are shown on their statements, whether it be, okay, you have wash sales, or you have 2, 3, 4 years of built up unrealized gains, and then all of a sudden someone redeems and they get hit with what's called stuffing, and we'll talk about that in a minute, which is those at the end when someone takes their money out, that tax and tax basis capital and the book value have to kind of come together. They have to match. So what happens is someone can have these huge amount of unrealized gains that they don't pay taxes on for 2, 3 years in a row. They're thinking everything's great, and then all of a sudden they get hit with a year where they owe more taxes than they made in actual cash. And that can lead to a bunch of confusion and obviously upset investors. I think the best way to get ahead of this as a manager, is when you do your tax returns, to compare the two, right? Just pick a handful of investors, mostly, ones that didn't have a lot of movement. Compare the tax basis capital on the K1s to the book value on their statements at the end of the previous year. And that'll tell you how far off you are. And if you are off by a significant amount, it's probably a good idea to send a notice, whether it be a letter or something. ChatGPT can even help you kind of write this type of stuff these days, but write something to your investors to let them know that there's accrued unrealized gains and it was a very good tax year for them, but in the future, don't forget that this will come back at some point. You're going to eventually have to pay taxes on these gains. It's probably a good idea.
Good point. I mean, I think, that example I gave earlier about the mutual fund at 1099, I think most people sort of understand that if they look at their investment and reinvested dividends and they understand that's their basis and the value is much higher, they get like, okay, I have unrealized gain here. If I sell it, I'm going to have a gain. There's the K1s are sort of like there's a lot there. So it's like, what am I looking at? And it's like, just remind people, like, break it down to that basic. It's the same situation. So let's flip over to the K1 quickly and just kind of see what that looks like. So, again, here in this example, their ending capital account. So if we just wanted to talk about how do I reconcile this, like, okay, fine. Like I want to review this. How do I reconcile this? So this number here, current year income loss, is 5746, is the net of all the taxable items of income and deduction here, right? So this is the total. Here's the character and detail. So using Greg's example, if we pulled this investor statement and said, it looks like year to date they've made $10,000 this year. So that means that, roughly 57% of book income is taxable this year, which means that 43% is a deferred tax liability in the future. And understanding that, reminding the investors of that, helping them understand this is how this works, then that invariable surprise later, it won't be a surprise then, or maybe they'll remember that conversation. People forget if they've been in a fund for 3-4 years and they've been getting somewhere between 40 to 60% of book income as taxable, that means that you've accumulated quite a large unrealized gain. And then you could have a year where, let's say next year they have a $10,000 gain, the market's changed, they took a bunch of profits, they, taken more defensive positions. That means they're realizing a ton of income. They could have $10,000 of book income and $40,000 of taxable income. The real measure, though, is cumulatively, where are we, right? If that extra 30,000 of taxable income in that year, based on them turning the portfolio over, just kind of catches them up from their prior 3 or 4 years, like that's a conversation to get in front of.
Yeah, and correct me if I'm wrong, Alex, but in that case, you would, instead of comparing that current year net income loss, you would look at the ending capital account balance, the 114, and compare that to the statement that says maybe 130. And that would be your cumulative
number. Exactly. Yeah.
Right.
Yeah. Right. So, if this was that case here, maybe this capital account, instead of being 130, would be more like 140 or 150, right? And then we're like, wow, we're sitting on a lot of unrealized gains here. Good performance, but still it could be a surprise for someone. So, how do I reconcile this? So, I'm reviewing it now. I have last year's K1. So you're going to want to make sure that the beginning capital account matches the prior year. If there are any capital contributions and distributions, are those reflected here as part of the accounting? Also important, if those contributions or distributions represent something other than cash, the basis number and the fair market value likely will be different. Contribution securities, distribution securities. Again, this is the tax basis number. So if somebody redeems half of their account value in stock, the distribution number is not going to agree to what's on their account statement. If the account value is 150, they got 75,000 of stock distributed to them, it might only be 10,000 at basis, which will be down here, and that difference represents unrealized gain.
Yeah.
So, if people want to get into it, want to understand how these reconcile, there's some of these numbers here are informational. It gets a little confusing what's included, what isn't, I think beyond the scope of this call today, but you add up all the items of taxable income and loss, you should get to that 5746, prove out that works. The other things to look out for, liabilities here. So 4636 beginning of year, 16955 end of year. This isn't probably going to be too meaningful for most investors in a alternative fund. This can give you basis. This happens more in situations where, like, management companies, where they're starting a management company, they're not putting a lot of capital in, they don't have a lot of tax basis. Greg, you mentioned some of these businesses that take advantage of leverage and accelerated depreciation. That can really draw your tax basis down. It could make it even negative. Well, if you're borrowing a bunch of money in that business, you're going to have a nice chunky liability here. Generally, these are allocated based on ending ownership and beginning ownership. But it could be different depending on the industry. It could be different based on the operating agreement. But this should pass the sniff test in terms of what your balance sheet liabilities look like. Are we seeing that here on the K1? Let's see.
One quirky thing that showed up this past year as well. Is
impact of negative capital.
On that recourse, non-recourse, is make sure on the liability side that it's booked correctly, whether it be on recourse or non-recourse debt. Obviously, if you're a passive investor, you likely do not have recourse debt. Right? So make sure that as an investor that you take a look and make sure that it's booked as the proper non-recourse debt as opposed to recourse.
Thanks, Greg. Yeah. So negative capital, if you see negative capital, you should definitely talk to your tax return preparer and make sure that makes sense. Most alternative investment funds that are trading liquid securities have stuffing provisions, which Greg alluded to earlier, that effectively struck the, by way of the operating agreement and available interpretation of Internal Revenue Code, struck that tax return preparer to specifically allocate the appropriate amount of gain or loss that investor needs to get their tax basis to zero. The reason that's important is that if you redeem, you get a final K1, you have a number other than zero as your ending tax capital, that suggests that there's a gain or loss on disposition of that interest. Or if it's not final and you receive the distribution and that distribution turned negative, or the third thing is if you have big losses and those losses turn negative. in all those cases, you want to understand, is this right? Is it correct? Or we found the partnership agreement, like what led to this outcome? It can't happen. There are reasons for it, but you want to make sure it's correct. If I'm reviewing K1s and I see that's my first question, like what led to this? If you do have a distribution in excess of basis, that's going to be, if there's not liabilities to give you basis, that's going to be taxable income generally. If you have losses that exceed your basis capital count and you don't have liabilities, that loss will be suspended. And if you have a K1 mark final and you've got a number that's non-zero, you'll have a gain or loss. So, there's all could be things that are correct and appropriate, but in general, especially in alternative investment world, a question worth asking, like, why is this happening? Are we sure this is correct? And, is there some tax consequences I need to communicate to my investor? Or if I'm getting the K1, that I'm going to participate in myself. Okay. I'm not going to spend a lot of time on this. These are all things that can limit losses. I feel like it's a conversation for another day. Just high level, we talked about the basis limits at 740. That's what we just talked about. Risk rules and passive activity. Often, hedge fund investments are considered non-passive, even though the investor is not materially participating, because there's an exception under 1.469 temporary regulation. But if it's a business or they have investments in, it's a diversified fund strategy and they have investments in operating companies that are passing through trader business income and state source income, that investor is almost certainly not materially participating, so there's going to be some passive income and loss. Those are important details that, the face of the K1 may be correct, all the capital might be correct, but that detail is important to make sure that, it's being captured and disseminated to the investors. Again, 461, there's some excess business loss considerations and specified service, QBI, sorry, specified service traders of businesses. Let's just flip to that real quick on this K1. There's a attachment in the K1 here that lists the investors' QBI. So when the tax laws changed for 2018, they lowered the corporate tax rate for 1120 filers, then put through partnership filers this qualified business income deduction, where you can get up to 20% deduction against income. Generally, it favors non-service businesses, like professional service businesses, so accounting, law firms, IT. But if it's a service business where there's property being used, or property management company, landscape or construction, all those things get the benefit of it. If you are a entity that's prohibited from that, you're known as an SSTB, or specified service trader business. You can see here, this is flow through. This K1 that we took was from a multi-strategy fund that had some of its own activity and some pass-through activity. So it's got a little bit of everything. So it's a pretty good example for looking at some of the different kinds of things that you get. So they made some investment in another fund that passed through, some probably own a business, have an interest in a business, it's a pass-through, and there's QBI income here. It's important to see that that's there. It's not marked SSTB. So as long as that information's being gathered and passed through and you trace it to the source, it seems correct. That's important to send to the investor. So another area that's important to focus on, box 13 is where our expenses are detailed. And for investment funds, we, many on the call may be familiar with the difference between an investor fund and a trader business fund. The code there is important. 13AE is a portfolio deduction, generally non-deductible. So if you're a buy and hold fund, your audit fee, your admin costs, your legal costs, all those things are going to be portfolio deductions that are not deductible. If you're a trader, quant fund, in the cash at the end of every day, whatever the case may be, high volume of trading, short price movements, etc., those are going to be on 13ZZ, and those expenses will be fully deductible. So that's an important distinction. Footnotes should be consistent, make sense. As a K1 reviewer, understand what nature your fund is. Is that consistent from year to year? Look at the prior year K1. And then if it's changed or doesn't match your understanding, talk to your tax code preparer. So this can change year to year, depending on the activity.
Thanks, Alex.
If you're a trader last year, so it's not, doesn't mean you're a trader this year. Okay, I think we're ready for another polling question.
Yeah. Partner receives foreign taxes paid reported on the K1. Which form is commonly used to claim the credit?
We covered that.
This question is probably more for preparers than it is the end user.
Just any, by the way. So, okay, so K2, we talked about this earlier, K2, K3, I'm not gonna spend a ton of time on this. They can be very voluminous and there's a lot to review. So this one in particular, I think is like 30 pages or something ridiculous because the layout of the form is actually like pretty terrible as far as the IRS when they design the form. Essentially, you know, part two and three really deal with that foreign income we talked about. You know, you're investing in non-US securities, you get some interest and dividends, you have some foreign tax withholding. What you'll see here is you can see the countries listed here, you know, country code, and you know, different investors have different ownership amounts. So this investor has a smaller ownership amount, so he has all these listed items. And then we get down to, I think this is Hong Kong. Okay, we have $130 of Hong Kong dividends. So it just goes for pages and pages. What you say, okay, well, how do I review this? This one is difficult because it's so many pages. A lot of them are only 2 or 3 pages. If you wanted to add up the total dividends on here, is it within a rounding difference of what's on the K1, base of the K1, right? This is supplemental information. It's providing detail and breakout of what's already reported on part 3 of the face of the K1, just so you can fill out the form 1116 or whatever the case may be. The one area that you can go to just say like, okay, how do I know that this works in total? I'm not going to go through every single number. If you get down to the end of part 2, it gives you a net income total. So it's 6,014. Now what this should be, there can be differences, but generally this is true. You take your distributive share current income from box L, which is your sum of your total tax items, and you add back to that the foreign taxes on line 21 should equal this number. So so let's see, what page is this? 48. So we go back to page 1. So 5746, add back, this is net of this foreign taxes, that gets you to 6,014. Okay, in total, my K3 reconciles. The other thing that's important on the K3 is if there's a part 10, so it's here. So if you have investments in, if you have either foreign investors or investments in foreign assets, there'll be detail here that's important. This particular fund doesn't have any non-US investors, but if you did, so for example, this ordinary gross income, and you see ECI, US source, like this should tell the preparer of whoever's getting the K1, hey, if I have a foreign partner, like, or even this partnership, if I have a foreign partner, I'm gonna have to do withholding on that. If you are taking this to another K1 or to another person, like if it goes to a non-US person, say a Canadian investor, if they know what they're doing, they're gonna look at this and realize like, oh shoot, that's US income, I have to file a tax return, or I have to talk to somebody about whether I need to file a tax return. So the detail in part 10 is important to understand as well. Probably difficult to fully reconcile all these things yourself. Might be a follow-up question for your preparer. Let's see, this is more K2, K3. So I'm gonna go over some of the stuff quickly here. This also would be reflected on part 10 of the K3. If we have investments in passive foreign investment companies, so what's a PFIC? Passive foreign investment company is a hedge fund that's not treated as a partnership for US tax purposes, often foreign, like a BVI or Cayman Corp. Sometimes we see this more like, let's say it's a European fund structure. Maybe they don't have enough US investors to do a dedicated US feeder. They'll just let the US investors subscribe to their probably BVI or Cayman fund that they're managing. If they're willing to provide you with a tax reporting statement, a PFIC annual information statement, that gives you information that you can pass through and allows for certain tax elections and reporting for the US investors. That's going to be denoted, or should be denoted in the K3. Sometimes there's footnotes. that, tell us that there's PFIC income. The other thing that's not universal is whether or not that tax return preparer has included that PFIC income on the K1. Sometimes it'll say this hasn't been included, has been included. That's more meaningful to the tax return preparer, whoever's getting that. So whether it's an individual or another fund, another partnership return preparer, they should understand what that means and where to kind of reconcile that. So I think as a reviewer, it's do I have knowledge that I haven't a PFIC? Is that disclosed on the K3? Or if I didn't, it's an entity that's like, no, I had that and I see that from another partnership investment, and it passed through to me. So those are details that it'll be hard to reconcile just from the notes and records you have, but important to understand what that means and see if there's a follow-up question. UBTI, if you have tax-exempt investors or pass-throughs, UBTI is going to be important. That's not really business taxable income, it's informational. That's one sometimes you see people leave off. That's an important one to look. If you know you're trading on leverage or you're investing in trades or businesses, there should be UBTI. And then ensure tax-exempt foreign partners withholding reporting are handled correctly. So again, if we have source income, now there's not a UBTI withholding requirement at the partnership, but it's important that it's reported. But if there's U.S. source dividends, U.S. source earnings, there's could be withholding requirements that U.S. partnership has to do for that income to that foreign partner.
Yeah. So Alex, let me touch quickly on UBTI a little bit from a user standpoint, because this one seems to be very important, very complicated to some people. In reality, it's not terribly complicated, but the important part as a fund manager is that you understand whether you have UBTI generated on your fund or not, especially if you're a fund of funds, and make sure you understand if there's UBTI generated on your underlying investments and underlying K1s that you're going to be passing through, and what that is. For example, if you're passing through a hefty amount of UBTI, then your tax exempt or IRA investors, if you have any in your fund, will have to file and pay taxes on that unrelated business tax income. It's very annoying for tax exempt investors that think that they're completely tax exempt, and then they find out they have to file and pay some taxes. It is calculated based on the amount of leverage, generally speaking, that exists at the underlying level, and the gains generated from that leverage. A lot of the times it's not a meaningful amount of money. And I want to point out, because this was something that I dug into a lot this year, there is a de minimis limit that you don't have to pay the UBTI taxes if you owe under $1,000 as an IRA investor. And that's very important, because in the past, they used to say, well, if there's any UBTI, it's just more of a pain in the butt. You got to go file. In reality, if it's under $1,000, one of our clients I looked at this year and did an analysis on, and there was UBTI, but it was very, very, very small. You would have to have an IRA account with almost $5 million, or make 10 times the amount of money next year than they did in a very good year last year. So it's very highly unlikely that you have any IRA investors that would have to file and pay UBTI, despite there being some UBTI for all the investors. So it's very important that you look at that, do that analysis. Your tax preparer can probably help you do that analysis. But that is, I wrote blog posts about this in the past, and it seems to be one of our most popular blog posts that seems to keep getting more and more people clicking on it, because there's not all that much practical information out
there. And where you can have a lot, Greg, you alluded to it, is if you're trading on leverage. Like, so if there's a 150-50 fund, 150 to 150 short, the shorts aren't going to generate UBTI, but if you're going into margin for that long side, you could have 20, 30, 40, 50% of income as UBTI. So if you're using leverage, especially, it can kind of get away from you. Which is why they have structuring for those investors to be an offshore fund. But I guess for any of the fund managers that may be listening to this, if you know you're trading on leverage, that would be something that would be good to follow up with your tax return preparer. Are they aware of it? Are they considering UBTI? It's informational. Your tax return doesn't have it. You might think, oh, great, I don't have any UBTI. But if you've missed it, it's an issue, right? That needs to be calculated and reported to the investors.
In reality, the one other kind of quirky thing that I've heard mixed things in the industry about is that, these IRA investors in your fund are not coming direct. They have to have a qualified custodian, and the qualified custodian is the tax ID that you need to use. So as a fund manager, you can't use someone's personal tax ID if they're coming in an IRA account. You have to use the tax ID of the actual qualified custodian, which is another part of the checks when you go back through the names, addresses, and such for all the investors. If there's IRA investors and they're all from Inspira, Millennium Trust, or Alto, or some others, they all have to have the same tax ID. Now, when you're filing UBTI and passing that through informationally to Inspira, for instance, and provide the K1 to Inspira, which is a qualified custodian, a lot of the times I've heard they are understaffed, or for whatever reason don't have the structure capabilities, and they don't pass that through to the underlying investors. So there is a chance that even though there is UBTI generated, that it doesn't make its way to the end investor. And because it's tied to the tax ID of the qualified custodian, there's no harm on the underlying investor from what I can tell. It's just it's whether the custodian passes that through or not to the underlying investors. And it's an exercise for them to do that.
Yeah. The good news is if there is a filing requirement there, it really is that custodian's responsibility to identify that and deal with it. So that's a conversation we have with our fund managers sometimes. Okay, so I'm just going to touch quickly on some of the stuff here. So if you have state source income, definitely something worth figuring out. Just the high level on states, and I don't have a state K1 here to share. The high level with states is to understand that the state K1 does two things. One, it provides any adjustments that are different under state law as compared to federal law for income in that state. So let's just take the example of U.S. Treasury interest. U.S. Treasury interest is taxable at the federal level, but not at state level. So if I get a K1 and I have $1,000 of interest on the face of my K1, I'm gonna put that on my individual return. But then let's say I was a resident of California. My California K1 is gonna tell me there's a subtraction from that, right? So let's say 300 of the 1,000 was from U.S. Treasuries. My California K1 is gonna show minus 300 for an adjusted $700 of interest for California purposes. So again, the first thing is, are there any differences between state and federal law? And needs to represent that to that person receiving that K1. The second thing is, if there's state source income for any non-resident of that state? Let's say California resident, I got my California K1, it told me I had 300 less of interest to pay in California, great, pick that up for my California return. Let's say I also get a Virginia K1. Example we had before, we got restaurants in Virginia, and I have $1,000 of, let's say $1,500 of income from the state of Virginia based on, my K1 has 10,000 of income, I have 1,500 from Virginia. Well, that means that, all other things being equal, I should be filing a Virginia return, picking up that income. And very likely that partnership has also withheld some share of tax for Virginia that hopefully covers that. So as a reviewer of a K1 in the fund capacity, look at the state K1s. If we see source income, does it make sense? I think one mistake that sometimes happens, like can slip through review and some of those things, is 100% of that income is whatever that adjusted income is showing a state source might not be correct, especially in an alternative investment fund. Very often most income, if not all, is not sourced to a particular state. It's generally picked up as income in the state that person resides in. It's only if there's activities which are considered trader business that state would tax that you'll see that source income. So it's usually like real estate or investments in operating companies that are passed through or things like that. If we're buying and selling stocks, options, bonds, digital assets, investments in other funds, generally not going to be source income. Somewhere there needs to be like a trader business in that state to kick that through. Private credit is an area we're seeing it a bit more because a lot of private credit strategies are actually engaged in the business of lending. So that's another area you could see it. If you do have state K1s, very often probably going to be some withholding. So understand, is that withholding being reported? If I have $1,500 and I had $100 of tax withheld, do I see that credit? Is that on the K1? And then once you get into states, there could be conversations about, can we file a composite return? That composite return is something that can be done at the partnership level, which eliminates that non-resident partner's filing requirement. If there is a composite return filed, is it very clear on that K1 that it's already been reported? You're still going to give them a K1, But if I got a K1 for Virginia and it showed me income and tax withheld and a composite was filed and wasn't clearly denoted on the K1 either with a box been marked, which not all state K1s have, or a footnote, I'm going to send that to my tax return preparer and pick up that income twice. Three or 4 point questions. If we're gonna have to hurry to get to the last one.
Yeah. So what's the best first step when a K1 doesn't tie to the investor admin statement?
Hints here. So I think based on what I think the answers are, we need some ability to reconcile that to from tax basis to the admin statement. Okay. Okay, so these are tips. I'm going to go through these quickly. This is the type of content I think you guys can read through. You know, automation using templates, and this is, I think we get into some content where if you're like really reviewing, you know, even at a preparer level or reviewer level, this is helpful. Standardized templates, understanding the difference between gap and tax basis. K3 delays, sometimes we see K1s going out, and then they'll say like the K1, K3 or states will info will come later. Don't lose track of that. You know, there's your K1 April 1st, and then you don't get the other stuff until June. You don't have the whole K1 yet. Checklists are great. We use them here. Who's reviewed what, sign off specific items that we're checking for. These deep dive tips, I'm really going to just let you guys kind of review on your own time. And back to the polling questions again. So, yeah.
So which of the following practices helps ensure accuracy and completeness during K1 data imports?
Okay. With the few minutes we have left, I want to just go back to the K1 and look at some more detail that's here, guys. So, you know, quick recap. We talked about, you know, using the prior K1 information to make sure everything rolls over properly. If you want to understand, you know, how these items relate to current income, you can add up the income and deductions and see everything. You know, does the tax basis versus the book value make sense? Any surprises? And then, you know, it's important to kind of really look through the detail here. So every K1 looks different, software is different, for preparers are different, but they generally have reconciliations or additional detail. You know, interest income 50/60, interest income that's fund level, and this is for cluster. Not a lot of detail there, but you don't know. It could be some very. This could say U.S. Treasury interest here. If I just picked up the number on page 1, I wouldn't catch that. You know, they could. What you often find is that the same types of information are presented in very different ways from firm to firm. So it's important to look at all the detail. So just more detail, we got qualified dividends, royalty income. There's not a whole lot here that's too meaningful, but then we'll get into a host up. Oh, there is one. This is talked about line 13A versus EZ. You'll see here, this is line 13 of the deductions. We've got AE, portfolio income. These are non-deductible to individuals under current law. So we're at 1,098, but we have 6,190 that would be deductible, and there's a footnote later that tells us that that's deductible. So let's use the best. So code box 13 code E, portfolio income. These are no longer deductible by individuals. Okay, but then the next line down includes deductions that may be deductible to trader business deductions, specifically tax advisors. So if we just pump numbers into the face of the K1 into the software, we won't always get the right detail. The other thing is line 11 often has like breakouts of information. I think this K1 is pretty straightforward and does not. Let's see. Yeah, other income from past through 1256. Sometimes you'll see things like trader business interest expense, section 475 income, swap gain or loss. You know, all this detail that may have other additional meaning. You can't just say line 11F, here's the number, it's ordinary income. So understanding that level of detail, reading through the footnotes make sense. Do they relate back to the numbers that are there? It's not uncommon to see footnotes that, like, let's say a fund was a trader they've got 13 ZZ expenses, but a footnote that says they're an investor. It doesn't make sense. Like, one of those things is off. They're really designed to be footnotes that relate to other tax return preparers, so you don't necessarily need to understand them at the fullest level, but it should make sense. It should look consistent with the prior years. If you've reviewed other K1s, those are things that, like, does it look different? Does it look odd? Is there anything that I want to ask about?
Yeah. Perfect.
So I think we're ending right at 3 o'clock. Hopefully.
Yeah, I think we got through a lot, Alex, and maybe we eventually do like a more deep dive on some of these topics in future webinars. But appreciate everyone joining us today and going through and learning about K1s. I think it's an important aspect of fund management that a lot of fund managers don't understand what they're looking at when it comes to K1s. So very important.
Okay. All right. Well, thank you everybody for joining. If you have any questions, don't hesitate to reach out to either one of us. And thanks again.
Thanks, Alex.